I bought a little bit of Taylor Wimpey this week, and I bought it on the back of this report, and I think it doesn't look like the best report, and the market was a little bit unsure about it. Sent it a couple of percent down on the back of the report, and I'm not sure how it's finished the week. I assume it's fallen with everything else this Friday. But I would urge you to consider this in in a wider context. So we've had a sort of a lot of information come out recently. So we've had Forterra's information. They said that obviously sites are doing quite well, but the home owner market and the home extension market isn't doing very well at the moment. And then we had Marshalls come out. They're primarily like a sort of stone and landscaping kind of side of it. Their report was awful. They were having a really, really bad time. We had Vistry come out and said that, look, this recovery that we were expecting just hasn't materialised as fast as we expected it to. We've had Ibstock, who are dribbling along at the moment, but their earnings are way down in comparison. And obviously Travis Perkins as well, the builders merchant in the UK. Their share price is down nearly, I think it's either 15 or 20% this month. So that should give you an idea of the broader environment for the sort of building and construction industry at the moment. I think where I am, it's certainly picking up again, but we'll see whether that is a short-lived thing or not. So Taylor Wimpey, I thought, delivered a pretty resilient underlying performance in the first half of 2025, despite what I would say were softer market conditions in the second quarter. The results, when you ignore the fact that I said underlying at the beginning, were actually significantly impacted by increased provisions for fire safety remediation, some pretty bad cavity barrier defects. Obviously, that's something that they're going to have to go back and remedy in houses that are already completed. And if they're rendered, they may have to take the render off as well to get to it. So that is an expensive fix. Also, the cladding fix they're adding to that reserve as well, and that has now grown to around about, it's like $500 million, I think, for all of these errors. And then there's the CMA issue as well, which we talked about with Vistry. Taylor Wimpey is putting, I think it's either 20 or 30 million aside for that as well, providing that gets accepted. We'll see how that goes. So that led to a pre-tax loss, and it's sort of key to note though that the company, and I know we hate to start on it, Steve, but it maintains a strong balance sheet and it's pretty well positioned for future growth, and it thinks so too because it reiterated its full year completion guidance as well. So the figures, revenue was up about 9%, so it was 1.517 billion. It went up to 1.654 billion. Operating profit was decreased 11.7% to 161 million. And that obviously includes the 20 million charge for defective workmanship by a principal contractor. And then they ceased on site due to financial difficulties. Excluding this charge, operating profit would have been about 181 million. So you're just about $1 million under. So that's about an operating margin of about 11%, which isn't too bad at all, really. Op prof margin, so that was actually 9.7 then if we take that into account rather than the 12 it was the year before. And the loss before tax was 92.1 million, which is a pretty big swing to a loss because it was about 100 million in profit in this same half last year. And obviously, again, these are the exceptional charges from these increased cladding, fire safety provision, the Competition and Markets Authority related provision of about 18 million as well. So adjusted basic earnings per share then 3.2 pence. If we're adjusting that out, it was 3.8 pence the half before. Net cash decreased to 326.6 million, and it was about 564.8 million at the beginning of the year, but this is primarily due to essentially the dividend, final dividend in 2024, and also increased investment in WIP, which is work in progress. So tangible net assets per share, and the reason I'm telling you this is because that's what Taylor Wimpey pays its dividend from, was 117.5 pence. And in the half last year, it was 124.5 pence, which gives you an interim dividend of 4.67 pence per share, which is actually a cut because Taylor Wimpey was paying 4.8 pence per share in that half last year. So, and it's not a massive cut, it's only a small cut. But Taylor Wimpey isn't about growing the dividend. They pay 7.5% of tangible net assets. So that's how that dividend is worked out, in case you didn't know. So group completion, Steve, that was up 11%. That's 5,264 homes. That includes joint ventures. That was versus 4,728 homes. So a nice increase there, an extra sort of 10% of home. An extra 11% of homes built. Net private sales rate, that was 0.79 sales per outlet per week. And that's versus 0.75, so a little tick up. If you exclude bulk deals, though, this is when someone walks in and buys 10 of them, it was actually 0.73. But also, they gave us that stat last year as well, and it was 0.69. So it is marginally better by about 0.04. Either way you want to look at it, really. Cancellation rate was high. It was 14% last year. That's actually jumped up to 16%. So this is when somebody comes, reserves a home, and then cannot, for whatever reason, get the finance, or something else crops up, or can't sell the house, or whatever, ends up in a cancellation. So 16% of what's been reserved is being cancelled at the moment, which seems high, but it's actually pretty much in line with how they've been since interest rates have gone up, which I think is probably the main issue here. So total order book was valued at about 2.116 billion, which is about 7,269 homes as of the 29th of June. And last year, this was 2.01 billion, 7,451 homes. So less homes, but more value. Probably like that. That's pretty good. So average selling price was about 350k. It was 356k last year, but this is mainly changed down to just a selling, a difference in the mix of what's being sold. So I wouldn't worry about that one too much. So they've got 206 outlets. They had 209. They started with 206, they finished with 209, but they had 214 outlets the year before. And this is simply the difference is because the sites are finished and the houses are sold. So there's nothing to particularly worry about there. And the land bank, so on short-term land bank, they've got about 76,000 plots, which is down from 79,000. They own all of the land required for next year's completions, and 90% of this land has detailed planning, which means that essentially they're ready to go. So onto these building safety and provisions. I've done a bit of a deep dive into this for you, so you know exactly what it is. They've had to significantly increase their provisions for fire safety remediation, reflecting these ongoing investigations and updated fire risk assessments. So the cladding and fire safety provision is up by 222.2 million in the first half of 2025. The key drivers of this is some cavity barrier defects. So this is essentially a barrier that sits in the cavity that stops fire being able to traverse up the cavity and start affecting other parts of the building. So basically the rule is buildings over 11 meters have to have non-combustible insulation in the building, but that's not actually the case for buildings under 11 meters, because theoretically you should be able to escape from these buildings before the fire comes from the cavity into the building. So on these higher rise buildings and maybe 3-story buildings, they've not been installing these cavity barriers, or not installing them properly. And these are causing defects behind the brickwork and render, which were not visible when they were previously inspected. Now, this is the job of the building inspector to spot these, but it's also the job of the Taylor Wimpey site manager to spot these things. They're specifically trained to see these things. And you probably see him on that guy who goes around and does the snagging things. He often spots things that are missing. And this is something that would have popped up in one of those reports. So it is a bad thing. Whether Taylor Wimpey are at fault of this, I would say they're at fault for not spotting it. They're not probably at fault for not putting it in. That is the fault of the contractor. But obviously it's a bit late now. So 39 million is attributed to more cautious fire engineers' interpretations of cladding standards, and about 38 million is added of this is site-specific cost increases and things like professional fees and other contingencies. So the total provision for fire safety and remediation is now 536 million as of June 2025. Now, this isn't something that's just going to disappear off Taylor Wimpey's balance sheet. This has been put aside to do this in the same way that a bank would put aside money off the balance sheet for, or in a neater section in the balance sheet, for loan losses. This is essentially what Taylor Wimpey are doing here. The cladding remediation cash outflow for this year is probably going to be around 100 million. And the change in provision is going to affect the gross outflow for a longer period than we expected. So we think this is probably going to extend through into 2030 now, which means that Taylor Wimpey will obviously pay less tax because the profits will be less, which is likely to offset the increase in remediation spend in 2026. So there won't be a material change in cash flows in that period, we don't think. In terms of recovery, they're pretty confident that they're going to be able to pursue claims against the people who did this, essentially, the poor design, the poor workmanship, and the material failures. They've put no provision for recoveries in this, in any of this information. So should they get anything back, it will be, frankly, a bonus, Steve. They were pretty adamant that they need a rate cut or two, really, to get the sort of housing market stimulated again. They think that that's mainly what's affecting the broader economic environment. They said that the market conditions were softer during the second quarter of 2025 and that there are still affordability constraints. They said lenders remain committed to UK mortgage markets. Affordability is the significant issue, particularly for first-time buyers. This constraint on affordability is a direct consequence of the interest rate environment, which obviously affects mortgage costs quite a lot. I mean, if you've ever put your mortgage into a mortgage calculator and started at like 1.2% or whatever what they were during COVID, and then put in sort of 5 or 6%, which they got up to, you'll see a huge difference in your monthly amount, and that just takes homes from being affordable to unaffordable. So in response to these, Taylor Wimpey's sales teams are focused on driving higher quality lead generation and conversion to sales, and they're supporting this with improving the quality of their sites and locations. They said that despite affordability challenges, the company believes that the long-term fundamentals are positive and there is still a significant unmet need for UK housing. I think we're all in agreement that that's the case. Full year guidance, they said that the full year UK completions guidance, 10,400 to 10,800 homes. That's excluding joint ventures, so it will be more than that. You'll just have to strip that out later on. They think group operating profit will be about 424 million for 2025, and that reflects that 20 million unexpected charge as well. H2 operating margin is expected to improve in the second half of 2025, driven by higher weighting of completions, higher ASPs due to mix, that's average selling prices, and partially offset by what they think is low single-digit build cost inflation, which is probably about right at the moment. They think they're going to end the year with about 350 million in cash, specifically focusing on optimizing value from their owned and controlled land bank, operational excellence to improve efficiency and protect value, embedding sustainability across the group, and delivering reliable investor returns in a disciplined framework. In terms of shareholder returns, just to explain how that works to you, so they basically, Taylor Wimpey really sort of laser focus on maintaining a strong balance sheet as their priority, and then they follow that by investing into the business, which is generally work in progress and land for growth. Then the ordinary dividend payment before considering if a special dividend or they should make share buybacks with any of the surplus cash. The dividend policy is unchanged. It's been the same for about a decade now. They aim to pay out about 7.5% of net assets, or at least 250 million quid annually throughout the cycle. And they've done about 2.7 billion has been returned to shareholders since this dividend policy came into force, with about 1.2 billion in ordinary dividends alone in the last 4 years, or 3 years actually. I think it is. It's 2022, so it'll be 3 years. So yeah, that was pretty much what I got out of the report, Steve. I think this is it now. I think you've pretty much got your fire provision in, you've got your CMA money in, they've discovered this new issue, but I think that is quite well catered for in this report, Steve. Dare I say it's all go from here?
Maybe. You've got more detail than me on these things, but I have broadly similar themes, and there's a couple of bits that I'll kind of add in around there for you. So let's start where you started for the moment. Stock is down 10% this week, 15% this month. That puts us basically back where we were 5 years ago, and of course there was a pandemic on then, which means two things. One is that construction wasn't really happening that much, and two is interest rates were a lot lower. A very different landscape, but we're kind of back in the same place. And that sort of speaks to this idea that we have a long-term shortage of housing, which I hear a lot of people on a lot of podcasts making, and they're not wrong. But that is very much a kind of long-term issue. That's been the case for a very long time, and a lot of house builders have not been great investments despite that fact. They have found ways to, in a lot of cases, underperform. In fact, the house builders are generally, barring a couple of slightly odd cases like WPP, the worst FTSE 100 stocks of July, they are the group that are down there. A few individual cases make their way on there as well. But, and here comes the but UK Construction PMI, which is Purchasing Managers Index, which is a good forward-looking measure of economic activity. In the case of UK construction, there's good news and there's bad news on that front, and the good news outweighs the bad. So the bad news is the most recent measure we have is 48.8, which is below 50, which indicates that the thing is in contraction still. That's where the bad news ends. The good news is that since February, it's been rising when it was down at about 45, so it's now contracting less. The even better news is it's forecast to climb and get into certainly comfortably positive territory by September, and then sort of plateau a bit at kind of slowish growth. And the even better news is that residential construction, that part of it, is at 50.7. So that bit is heading back for growth mode, according to the PMI. These things are always, these things are forward-looking statements. It's hard to be certain on these things, but one of the best indicators we have is the PMI, especially in construction, especially in residential. The closer you can get it to your industry, the better the kind of sign for the short term is. So you're wondering whether it's all go from here. Maybe it's starting to be go from here is a decent sign of that to be going on with. Elsewhere on the report, I sort of thought what you thought here. I can see what the market didn't like. It looks like that kind of big cladding provision thing is going to send it to a net loss for the first half, and it's going to mean that for those people who like looking at these things, the dividend isn't covered by either earnings or free cash flows at the moment. They spend about 300, and the number I've written down is 39 million on dividends. And if you knock off 222, which was the number I put for cladding, that takes their net income for the 12 months, so end of last year and into this year, below that number. As you say, this comes out of assets, and it's computed based on that. So it tends to be a much, much, much more stable dividend than you would find at Barrett Redrow or Bellway or pick your other favourite house builder, definitely Vistry, all over the place with theirs. But you can only do that for so long until you run out of assets to start paying things out of. And if your asset base goes down because you're dividending it away, then your dividend gets cut slightly. And you saw a small dividend cut here. The kind of positive news on that front is that I saw management was still guiding for 400 million in operating profits for the full year. That does cover the dividend, so you get back to coverage pretty quickly. I realise they're not going to cut it because they'll pay it from assets, but nonetheless, you keep chipping away at your assets eventually. It kind of works as a nice way of bridging through, basically. But you don't want to be bridging forever, and they're not going to be bridging forever, at least not according to their guidance anyway. This year, things will cover, and that will be largely fine. The order book I thought was in decent shape. It looks like it's roughly similar value to where it was last year. With, as you say, fewer houses but more money, so that seems like a good place to be in. There's a bit of build cost inflation coming through. A rate cut would be nice. It looks like the next direction for rates is down, doesn't it? And inflation isn't really a major issue at the moment. I do wonder when that will be coming, but at the moment then you're looking at Taylor Wimpey after this latest bunch of declines as something like a 9 and a bit% dividend. You don't need the stock to do an awful lot from there to do pretty well, Steve, and things are starting to look up for the construction sector. I had this on my list as my kind of candidate number 2 here. I'm not super into house builders and what differentiates one from the other. I can say some basic things. Vistry is the obvious exception that I know a bit more about. Barrett Redrow has an advantage in terms of scale, I imagine, because its size helps, and we've talked about things like DR Horton and the advantage there that comes from being able to set things up and keep things moving and preferential arrangements with suppliers and so on. Taylor Wimpey, of course, I think of it as mostly distinctive because of its dividend policy, and you will get a smoother passive income, right, if that's what you're in for. No reason you shouldn't be at that level. It's rare that I find anything with a 9% dividend that I don't hate, but this could be that kind of stock, to be honest, or at least, at the very least, think there's something big to worry about. I can find things at sevens quite a lot of the time that I think are okay, your primary health properties of this world. 9% tends to be where I start thinking, yeah, but it's a tobacco company, isn't it? And the question with tobacco companies is, well, they're going down, but the question is how fast. And maybe there's definitely a dividend yield that's worth it, because you'll get so much money back that by the time the thing's gone away, you'll have all your money and more and be gone. That's not the case with house builders. With house builders, they're definitely not going. They better not be going away. You'd be unlucky if you thought they were. Certainly, their industry is not in structural decline. It should be in structural growth mode. They have things to deal with like inflation. But Taylor Wimpey, I think, looks pretty interesting here, and the dividend situation might be what sent the stock down, but I don't really see that as a big kind of concern. It's a genuine cash cost that's been kind of put to one side. So you can't use that to pay dividends out of, but it's also, I think, probably one-off in nature, and their guidance is acting like it is, certainly, Steve.
Yeah, I think you're right there, Steve. I think basically what we've seen from all of the house builders is they have this ability to snatch defeat from the jaws of victory, which is something we're seeing fairly regularly with them. But I think it's worth touching on, Steve, before we shuffle on, just how Taylor Wimpey purchases its land, and it's basically the same way that they do over in America, which Steve and I admire a lot. So rather than buying Farmer Joe's field when it comes up for sale and then kind of hoping that you can get planning permission on the land, what they do is they take options on the land. So they might say to this farmer, look, I'm going to take an option to buy this land off you at full price in the next 10 years or so. And here's some money up front for me to do that. But if I don't buy the land in those 10 years, you get to keep the money and the land. And I have no claim to it. And what Taylor Wimpey then does with that is tries to make sure it can get planning permission for what it is, runs tests and simulations on the site to make sure that they can actually build the required amount of houses and go through the detailed planning process to make sure that everything that they come up with, around the table is actually going to be functional on site. Then they weigh it up against the cash cost of the land and what they've already paid to take the option of the land, and they'll probably find that it's a very profitable piece of land, providing build cost inflation doesn't go crazy, and they can then to basically pay the full value for that land, for Farmer Joe's land, and commence at some point in the future building those houses on it. And what this allows them to do is mitigate risks. So when the housing market is collapsing and mortgage rates are flying through the roof with interest rates, you can let these options expire. You're not sat on huge amounts of land that you've paid massive amounts of cash up front for and not really able to build on them because, one, nobody will build the things you've bought and it's probably too expensive to build on them. That's not obviously that's not a great idea, but also it allows them to have massive long-term land banks without them actually spending a lot of money building these land banks up. So it's essentially a way of a promise to buy the land, but without the financial burden of actually buying it yet, which allows them to, because you can't build on an infinite amount of land because there isn't an infinite amount of builders of a required quality to build the houses that you need to do. So it's better to take options on this land, buy them over the 10-year period, bits and pieces, but you still own all of that land technically. But you can then build on it in your own process, and you don't run the risk of a competitor coming in sweeping up that land off you. So it's a really good method. We liked it in America. We didn't realize they were doing it in the UK, but a lot of UK companies, the decent builders, do this method, and it is just worth noting how that is pretty good for maintaining a good land bank, Steve.
Yeah, and it also has the advantage, that's the reason that UK house builders pay dividends in quite the way that they do. It means that every time you sell a house, you don't have to take all the cash and plough it back into buying more land and then building more houses, because you can imagine this gets expensive eventually. And sticking to options here, and then you only kind of permit what you know you can sell, basically, or start building where you know you can sell. Helps you very much in the case of you have cash, you can return it to shareholders much more efficiently, and that's why their balance sheets are so strong as well. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.